Okay, so our main focus today is going to be the manual calculation of tax. Now we're going to have a look at this in a few different ways. We're going to have a look at English, Welsh and Northern Irish tax, and then we're also going to have a look at Scottish tax. Now we will have a break in between the two modules to allow you to go and get refreshed and come back to some Scottish tax. So first off, we're going to be looking at the English system, why we need to do that, and the rates at which we need to charge to our employees. So when we're looking at the calculation of income tax, we need to make sure that the company is meeting all of their statutory and contractual obligations. So this is PRT1, so this starts off our technical modules, and this shows a taste of what we need to build up to in order to reach a confident gross to net calculation. Now I'm going to share a poll, and I'll allow everyone a couple of minutes just to have a look at this poll and answer as honestly as you can. If you don't feel confident, then I'd like you to be honest, but I'll just launch this one here. Okay, so what I've asked is, how confident are you in approaching an English tax calculation?
While everybody's doing that, Sam, can somebody privately message me with the email address of MSC? And there's also Tracy Marshall that needs a link. When I've looked on the registrars, I can't find their email addresses, so I can send them the link if someone tells me what the email addresses are.
Fabulous. Thank you very much, Helen. Okay, so we have a mixed bag as the votes are coming in. So we have quite a few people. The majority of our attendees here are okay, but they have some concerns. So hopefully what we'll do in this presentation is just alleviate some of those concerns and fill in some of those gaps where you feel, oh, I'm not too sure, and that's what's going to create the anxiety around the calculation. Okay, so I'm going to close that poll now, and we have a result of 55% of our attendees saying that calculations for English are okay, but there are some concerns. Now, well done to the 14% of you that can complete them start to finish with a bit of confidence, and for the 32% who are out of their comfort zone or not at all confident, we hope to change that today. So we're going to look at meeting our company's contractual and statutory obligations in regard to tax. So our learning outcomes for today, we're going to learn how to manually calculate the tax on our payslip. Okay, now here we're going to speak about why it's important. Why do we need to know the information in order to calculate tax from start to finish? The reason why it's important is not everything's perfect. Our systems nowadays, fantastic, but they do have problems. They do have regular patches because we have regular updates, and therefore we need to be able to manually calculate the tax to identify errors, whether that be through a manual input on a system or it could be a malfunction within a formula. So we can then use tax calculators to check, and we can verify our own calculations against HMRC's calculator. So tax queries are common within our departments. They often come in, why have I paid this? Why has it gone up or down? And being able to calculate ourselves means we can play with the theoretical and then compare that to what's happened in order to give a better answer. So as a result of having that information and being able to use those processes, we're going to gain confidence and also support those team members that maybe aren't quite there in terms of the skill level that you have. So when we're looking at the gross pay for PAYE, we're going to be looking at what's included, why do we include it, and when did it start? So income tax is something that's been done by PAYE since 1944. Now, I'd hope that most of you know that there was something quite significant going on in the UK in 1944, and therefore this system allowed the government to recover tax at a much higher rate and much more sustainably. Without pay as you earn, it gives individuals the opportunity to manipulate their taxable income and therefore not pay what is owed. If it's the employer's responsibility, then they're making sure that everything is taxed at source and therefore correctly done. So here we can see a grid of the payroll calendar month. So as you can see, we run from the 6th of April to the 5th of April each year. And here we have a list of all the tax months that you can use. Now, when you come to do your tasks from this session, you can use this as a guide for when your pay period is. So if your date falls within the 6th and 5th of those dates, then you're going to be in the associated tax month that you can see in that table. We now have the equivalent of for weeklies. These go from the 6th to the 5th. If we go to the next part of the slide, there we are. In the same way as you would do with the monthlies, use it as a nice guide to show which tax week you're in if you're doing a weekly calculation that's cumulative. Okay, so if you do monthly payrolls, you may not know that this is the case. However, if you do weekly, fortnightly, or lunar payrolls, you're more likely to know that in the case of a leap year and how the dates fall, you may need to include an additional pay period within that year. So as you can see, a weekly, adding 1 is 53. A fortnightly, every 2 weeks, we're adding 2, that's a 54th period. And a lunar, it'll be the 56th week because we pay every 4 weeks on the lunar calendar. So here we have permanent and variable payments that can be included in our gross pay. So the most obvious one is going to be our annual salary, our wages, and then any allowances that we get as part of our remuneration package. So that may be a car allowance, that may be a London waiting allowance for anyone based in our capital, or it could be anything all the way down to, I saw once, a lunch allowance, which is fabulous for anyone that gets it. So we have variable payments that can go up or down, they can appear, they can not, and they're going to be your overtime, your commission, holiday pay, all of those things that you may attract as a result of your situation. Now, what we include in PAYE is very important, because if we don't include the right figures, then we're not going to charge the right amount. Everything's going to be incorrect. We're therefore non-compliant. Big problems for our company. So what we need to do is make sure that we're including everything that we should. So the first one that we have here is all earnings due from employment. So that is going to include our cash vouchers and our shares and our benefits, because they're all our earnings from our employment. They're going to be stated in our contract, and they're therefore going to be included in our gross pay. We're also going to include statutory payments, so our SSP, SMPs, all of our statutory payments that we must pay to an employee. We then have payment in lieu of notice. So if you're paying a person instead of them working out their notice, then that is also a taxable item. And then this is an important one, redundancy pay, that's over 30,000. So if you have a redundancy package that's under 30,000 and the redundancy pay is under that, you're not going to be paying tax on that. So we need to be careful when we're doing those severance payments, because they're sensitive situations anyway, generally speaking. So it's a lot of responsibility that we have. Now, you can see here we have what to exclude from PAYE. This is going to be our net pay arrangement only for pensions. So this is our equivalent, the old salary sacrifice scheme. We're then going to have give as you earn. also known as charitable contributions, our approved cycle to work scheme, and our redundancy pay under 30,000. So cycle to work schemes are now commonplace within most workplaces. You also have childcare vouchers, which will be tax-free, but they're closed schemes now. You're not going to see any new entrants to those. You may see that there's a lot of employees with low amounts as their value, and that's because if you come out, you can't go back in, but you are able to adjust your amount up or down. So someone who may use it in the future, I found that is a common thing to lower it to the minimum allowable within your company. So PAYE is usually calculated cumulatively, but it can be calculated each period. So by cumulatively, we mean that we get everything that they've earned up to that point. We then calculate how much tax is due on everything they've earned, and then we take away all the tax they've already paid. That's going to give us a balance, whether that be positive or negative. That's their tax balance for that month. Now, if we're on a non-cumulative basis and we see that month or week one indicator on a P45 or our system or wherever we're seeing it, we're only going to look at that month in terms of calculation. So that means that we're going to prorate all of our different bandings, all of our rates down, so that it's appropriate for the pay period and frequency that we're using. So if we're weekly, we're going to divide things by 52. If we're monthly, we're going to divide it by 12, lunar 13, so on and so forth. So our tax codes, this is what defines what our tax-free amount is, but that can be negative in some cases, so it's not tax-free in itself. We've got lots of different codes, and you will have come across some of them. You may not have come across all of them, but we'll go through them in a moment. So what they do is indicate a pay adjustment. So this lets us see how much we need to charge someone in terms of their tax-free allowance. Now, you will have come across an L code, or I hope you will have come across an L code. This is our most common one. You will see these on most people's tax codes, and these are the ones that are going to be uplifted when we get our blanket tax uplifts in April, so our P9X. Now, M and N, these are the ones that are used to indicate whether you've transferred or have received a transfer of personal allowance from a spouse. As you can see, this is allowable for up to 10% for the emergency code at any given point. And what this allows people to do is get 10% of their tax-free allowance and transfer it to a partner if they don't earn the full tax-free allowance. So it allows the partner who does earn over the tax-free allowance to get those savings in tax. So a T code means that there's other calculations to work out your personal allowance. Now this will generally be accompanied by a P800 to the employee. So we don't see it, but the employee does. They get a calculation to say, we've had to have a look at your tax code and we've taken the following factors into account. So as you know, we can't change tax codes unless we're told by HMRC to do so. So when you have a confused employee that's asking about a T code, always good to see whether they've received the documentation to see what is impacting their code. Now, a 0 T code is one that we often see. So if we don't get any information, we don't get a P45, we don't get a start checklist, then on an OT, that new person goes. These are the people that you're going to hear from on their first payday that say, you've taxed me loads. You say, Unfortunately, we asked you for a start checklist and P45 and we were unable to process one. So we went and put you on a 0 T. Now a BR makes it 20% on all earnings. So we get no tax-free allowance and that's payable at 20%. It says here, usually used if you've got more than one job or a pension. So you've used your tax-free allowance somewhere else, but you're not going to be earning enough to be going into the 40% tax bracket. So that second earning is going to be on BR. Now the next two deeply unpopular tax codes, we have DO and D1. These are for the higher rate and additional rate respectively, which means that if you're a DO, you are on 40% of all of your earnings. Not a very nice amount to pay, but if there is a situation that means that you need to pay some money back, or you have other earnings, which means that all of those earnings are at the higher rate, then a DO is what you're going to go on. And a D1, 45% on all earnings. So that would be for an extremely high earner or someone that owes quite a lot of tax there. Now, NT is what I find that a lot of people haven't come across. This is for someone that's not going to be paying tax. Now, people that this could apply to could be an inpat or an expat, where they don't have a tax liability within the country that you are processing payroll for, but they have to be on payroll for other reasons, such as social security. So it could be that they don't pay tax, but they do have to pay NI, depending on their situation and the country that they go to and from. So now on to Scottish. A Scottish tax code is defined by having an S as a prefix. And the way that HMRC do this is by postcode. So if you have a postcode that sits in Scotland, they will issue you a Scottish tax code. This is if you spend more time in one area than the other within the UK, you'll end up getting given a tax code that's appropriate for the place that you spend more time. So as you can see, largely they're the same as English tax codes. So you're still going to see your L codes, you're still going to see your T codes. But when we go down to the bottom here, because of the additional rates within Scottish tax, you have DO, D1 and D2. And that's because we have SBR for basic rate, and then the intermediate, higher and top rates, which are 21, 41 and 46% respectively. So this next one for Wales. Now when we come to calculate Welsh tax, when you're actually paying the tax, there is no difference to English tax. The difference comes when the tax is distributed. So as a payroll professional at the moment, you don't have much of an impact, but that doesn't mean to say that it can't change in the future. So we have a C as a prefix for our Welsh tax code, and that's because Wales in Welsh is Cymru. So that's why we have C and not a W. Okay. So we have some changes to tax codes that we need to be aware of. So we've already spoken about the 10% transfer to a spouse or civil partner that you can have, who, providing that the recipient is in the basic rate tax group. We also need to be aware of high earners. So once someone starts earning £100,000, for every £2 that their adjusted net income is above 100,000, they're going to lose £1 of their tax free. So once you get to 125 grand, you're not going to be getting any tax free allowance anymore. We also need, you would also need to do a self-assessment tax return, and that's to verify that you have earned over that amount and that you can be charged the tax appropriately. So I did briefly mention the P9X, the blanket uplift that we do each year. So these are included in the notifications that we get from HMRC. The P6/P9, our tax code notification, we're going to get those throughout the year to say this person's situation's changed, therefore please change their tax or their previous pay and tax. We then have the P9X, which is our blanket uplift. That's going to say for each person on an L, an M or an N code, their amount needs to be raised by X amount of points. That's a good way of remembering it, where you don't know and it's just a stated amount that we're raising them from, X amount of points. So we also then get information from new employees. As I stated before, our new starter checklist and our P45 are the main sources of our tax code information, and our next slide describes what we need to look at on those. So our new starter checklist recently been reformed, so it looks a bit different than it did before. And if you're even older, P46 is what it may be colloquially termed in your organisation. So there's three statements that we need to look at. First off, if they choose statement A, this means that it's their first job since the start of the tax year and their first earnings. Therefore, you know that there's no other earnings in that tax year that you need to be concerned about. They get given the full tax-free allowance. We put them on a cumulative, so it looks all the way back to the 6th of April to give them their tax-free rates. Statement B, this says this is now my only income, but at some point in this tax year, I have earned some money. So that means we can't apply tax-free allowance for the whole year, because that means we might be applying it to a time they've received it from someone else. So what we do is we put them on the standard tax code 1257L, but week month 1. So we know that we're going to calculate the tax correctly for the months that we pay them, but we're not going to look into the past until we get all that information. We'll get that through HMRC if we're using the starter checklist. And then statement C says I have another job or receive state pension or a private pension, and it says to use tax code BR, and that's because it's assuming that you're using all of your tax-free allowance at the alternative employment and therefore need to be charged 20% on everything. Now, if you were a person that had 2 different employments or 2 different incomes, what you would then do is contact HMRC to say, I have income of this amount in one place, this amount in the other place, and you could potentially split your tax-free allowance between the two if they were both small amounts. And then, as we said before, if they have no information or it's incomplete, they've not signed it, they've not done it properly, we need to use tax code 0T month 1, week 1 if we can't get it updated before our payroll. So other impacts that we have to tax code. So there is a benefit to using payrolling benefits. That's an odd one, but yes. So there's 2 different ways that we can report our benefits. We can either put it on P11Ds at the end of a year, or we can get an agreement with HMRC to payroll them. And by that we mean we are going to calculate the value of that benefit, and then we're going to add that each month to the person's taxable pay, and therefore that person pays tax in real time. If we are to be reporting on P11Ds, HMRC is not going to know about the values of those benefits until that's reported on a P11D, and therefore may need to adjust the tax code for an individual in the subsequent tax year in order to account for those benefits they've received. So it will be down to what your company does, but you should have an awareness of both types of benefit in kind. So here we have the personal allowances for 21 and 22. We've got 12,570 is our new personal allowance, and our personal allowance income limit is 100,000. So if we're earning more than that, we lose £1 of our tax-free every £2 over 100,000 we earn. I say 100,000 we earn. I'm sure everyone on this call over 100k in salary. Married couples allowance, the maximum that we have is 9,125, sorry, and the minimum amount for married couples allowance is 3,530. Now this isn't to be confused with marriage allowance that you can see. The marriage allowance would be the transferable amount between the 2 spouses. Married couples allowance is much older, and I personally haven't seen an instance of it. And then we have blind person's allowance of 2,520. So when we come to converting a tax code to monetary values, we're going to take away the suffix and replace it with a 9. Easy as that. So when you have something on the end of it, we're going to have replace that L or a T with a 9. Now, the note we have at the bottom in terms of K codes is important, because we're going to still remove the letter and we're still going to add a 9, but make sure you put it on the end. If you replace the K with a 9, you're going to come out with a mad calculation that I don't think will be quite correct. So When we have a prefix that determines a geography, so Scotland or Wales, we take that off when we're doing the tax code calculation. So the manual methods of calculating income tax, we have the taxable pay tables and the calculator method. So the calculator method is used for your online filing, your RTI, and generally speaking, your system would use that one too. You can still use the taxable pay tables. They are very handy. And also, if you come to your role simulation, when you're being assessed, it's one of those things that you can take into your role simulation, and it has all of the information in it. So it's just a case of reading the right page. So the tables are split into tables A, which is for our tax code, and then it's tables B to D, which we use to calculate the tax. And once we go from tables A, B, C, and D, by that point, we know how much tax is due for that person. So they're available on the Gov website. Have them as links. Practice what you're going through at work. So if you get a pay statement or a query, go through, back calculate that tax. And once it clicks and you understand why it's calculating what it's calculating, you grow in confidence in being able to answer the queries and being able to help your teammates. It makes a massive difference. So HMRC pay calculators are only for the current tax year. However, you can go to other third-party suppliers if you need to. I wouldn't have any to personally recommend, but each one of you will have a payroll system that will produce X amount of calculations in itself. And using those as your guide, you can get the gross pay, half of the deductions area, and then make sure you're getting the same answers that your system is throwing out. Now, if you were to do that and you find a difference, that's not to say that the system hasn't had a malfunction. It could have a long-standing bug that's not been highlighted to the software provider, or it could have something that's been caused by input somewhere else. So that's why these are really important. This is what they look like. They've been in place for a long time. As you can see, tables A is the 1993 issue that we use. They're exactly the same because they don't need to change. We have a consistent formula and have been using that for a long time. Now, when it comes to the pay tables, obviously they're going to be specific to the year that you're working in. That one, April 2020, we can see there. Okay, so when we look at tables A for adjusting our tax code, what we need to do is use the highlighted bold numbers in association with the number that we are using from our tax code. So once we've knocked our L off, or our T, or whatever letter there was, and we've got that amount we need to charge, so 1257 being the current year's one, we're going to approach this table and then ask ourselves, is it within the range of the normal table? And it's quite an obvious no. 1200 is more than 500. So then we're going to use this box down here, and the easiest way to process these, for every 500 that you have in your tax code, you're going to use the number in this little box. So if we're looking at 1257L, we're going to get two lots of 500 to make up our 1000, and that is going to give us 833.34. And we're then going to look up the value for 257, and then that would give us the amount. Now, this one gives an example for 1236. As you can see, the 236 figure here is from our tax code, and the monetary value associated is a 197.42. Our personal allowance, therefore, once we've taken our two lots of the 500, for this calculation is 1030.76. And we have a note here. If it was 1000, you would use 416.67 in the box once, and then you'd look up 500 because we haven't exceeded that 500. Okay, so we're now going to move on to tables B to D. These are the tables that I find a lot of people find intimidating, but once you get it and you start going through it, they're really nice and easy to calculate PAYE. So in the front of them, you've got lots of lovely instructions and information. So when you're taking that into your RS mock or live exam, we have all of the tax rates for all of the jurisdictions in the front of the book. So obviously you can't take that into your multiple choice, but when you're asked those calculation questions or questions as a communication one, absolutely legitimate that you can have these to hand. Okay, so what we're going to do, once we've got our taxable pay, we've then adjusted it for our tax code, and we know how much we're going to tax, we take it to table C1. So you would use table C1, this is cumulative, if an employee had earnings that were liable to higher rate or additional rate. So in this case, what we're going to do, if we've got monthly earnings of 4,000, we're going to check, right, what month are we paying? This is going to be month 1. So first column, month. Month 1, we know which line we're working on now. It's this one here. And these tables, incredibly easy to read once you know what you're looking for. So our 4,000 sits between column 1 and 2. If you can say my number in the associated month fits in between columns 1 and 2, you know you're using the right one. Now what column 3 tells us is the amount of tax that's due on column 1. So when we come to do this calculation, we know that there's 625 due on the first 3125. All we've got to do is work out the remainder. So in actual fact, we're only ever calculating 2 lots of tax and adding them together. Nice and easy. So in this case, 875 at 40% is 350. We've added it to our 625. Total tax payable is 975. So we can use table D to calculate the amount for the 875, as it says down here, or when you're using a C table, and this applies for Scottish as well, which you'll find out soon, it will always tell you what the remainder has to be taxed at. So this one, we have tax at 40%. So we know what we're charging on the first amount because we've got the amount in column 1 that we've already taxed, and the amount of tax due on that in column 3. So then once we've done our remainder, that gives us our tax due. Okay, so now we're going to look at table C2. Someone's got a bit higher in earnings that we need to have a look at. And again, this is for month 1. So we go to table C1 and we say we've got £14,000 we need to tax. So we start at 1, always a nice place to start, and we look at month 1. So my taxable pay figure doesn't fit within these 2 figures. So this isn't the right one. I'm going to move on. We now move to table C2, and for English tax, this is the end of the tables. So we know that for the first £12,500, there's £4,375 payable. And that gives us £1,500 in remainder that we need to tax. So we could go to table D2 and have a look and see how much 45% would be on £1,500, very similarly to how we do tax codes. Or we can just look to the right of it here and it says 45%. So we know that the remainder has to be taxed at 45%. Now we've got some weekly tables. They work in exactly the same way, they're just prorated to weekly amounts. So we're going to take a weekly taxable pay We've adjusted, we've taken off our salary sacrifices, we've then done our tax code, we've now got an amount we need to tax. We've taken it to tables B to D and ask ourselves, does this amount of 1,000 sit between on week 1? Does it sit between 722 and 2885? Yeah, it does. So we know that we're going to be using the right amount here. Now, once we've taxed 722, that gives us 278 that's remaining. And we know what we need to do with the remainder. We have a look on the right hand side here and it says tax the remainder at 40%. So that's what we're going to do. That gives us £111.20. So our total tax payable, once we've added it to the 144.56, is £255.76. We're now going to have a look at higher earner, but weekly. So we've got £4,000 that this person's earned this week. Good for them. And we're going to go to table C1, month 1, and we're going to see, does that fit between columns 1 and 2? Nope, too much. So what we're going to do is move on to table C2. And this one, say for English tax, is the end of the C tables. So we know that £2,885 in the first week attracts a total of £1,009.78p, giving us a remainder of £1,115 that we need to tax. Let's have a look next to the column at 45%. If you're not confident with using the method of looking next to the column to find the value, like I say, we can move on to the D tables, and essentially it tells you this is how much you've got in taxable pay, and they're associated to the equivalent tax rates. So our gross pay, less personal allowances depending on the employee tax codes, remembering our K codes that they go on instead of coming off. And we can also reduce any taxable income with the following. So our childcare vouchers, remember our closed scheme, our give as you earn amounts, our cycle to work, and our net pay arrangement pensions. So we're going to have a look now, and there will be a try me section, which is great for a one-to-one, but I'm not going to have 45 people trying to do a try me at the same time. So I'll run through these, and then you can use the recording in the future to help you with going through your calculations. Really good way of making sure you follow all the steps. If you jot these steps down and run through some calculations using them, it is really handy to make sure that you're following the right process, because ultimately, if you have the right process and run it through, it's going to be fine for whatever figures you're using. So Sally James, we're going to do a calculation for, and Sally's salary is 26,000 and gets a car allowance of £450 per month. So when we're gathering our gross pay, so gross is big, we're gathering everything up. That means that we've got all of our elements that are being paid to the employee. That's 2616.67. So we're going to calculate the taxable pay now. So once we've gathered the gross, we've gathered the big bit, we're now going to adjust for anything that we don't need to charge tax on. So in this case, Sally has 5%, which is matched by her employer as a net pay arrangement pension, and she has £50 that goes to a charity of her choice through the Give As You Earn scheme. What we need to do is take those off of the gross pay before we do the tax adjustment. And that's important because of our cumulative calculations later on. So that gives us our taxable earnings. This is the amount we're then going to adjust for a tax code. So you can see on the right hand side here, you can use these slides to help you with your tasks, and they are attached to this session. So there's 6 documents as materials attached to this session, and what those are a copy of the modules that we're going through today. They're also a handbook to support the documentation, which is really good for revision. And And there's also the tasks for you to have a go at. Now, anyone that has a go at the tasks and struggles, let me know, I can help. If you go through and you whiz through them and you want more examples, I've got some that I've given to other learners, so feel free. I'm never going to say, no, you can't have more work, just to let you know. So once we've got our taxable earnings, we adjust it for our tax code to ultimately give us our taxable pay. That's very, very important once you get to the taxable figure to do something. Once we come to charge our tax, we only tax whole pounds. If you leave the pence on when you come to do your tax, you will get it wrong. So very important step, very easy step, very easy one to miss out. So make sure you're including that. So first bit, get all of your earnings together. So you gathered your gross being big. You then made sure that anything that doesn't have tax doesn't get applied for tax. So we've taken our pension off, we've taken our give as you earn off. They're now sat there ready to go to their suppliers. We've now adjusted for our personal allowance and we've got the amount we want to tax. We're now going to move on to another example. Where we have a month 2 calculation for Sally James. So Sally has been doing fantastically well. And she has received an annual bonus of £5,000 to be paid that month only. So that's going to drastically boost up the gross pay. So we're gathering that gross pay. And in this case, we've got the permanent salary, we've got the permanent car allowance because it's contractual. We also have an annual bonus going through. As you can see here, we're taking the same steps as we did with the other one. So we've gathered all the gross for that month. Now, the key difference that we need to look at when we're doing cumulative calculations instead of month 1 calculations is to make sure we're looking at all the previous earnings, right? So what we need to do, you'll see there is a key step here, which is adding in your previous taxable pay. Now this relates back to when I said it was important to do the steps in the right order, because if you don't, then you're not going to come up with the right figures at the end. So what we've done is we've gathered all of the earnings that the employee has. We've taken off anything that doesn't have tax applied to it to give us our taxable earnings. Now we have to look at everything else they've earned. So we're going to add in the taxable pay from the previous month. Because in this case, we're working in May, but the same principle applies if you were working in a tax month 10. All you would be doing is getting your current month, and then you get the previous taxable pay from the previous pay slip. And that's going to have the earnings from the start of the tax year up till then if you're doing cumulative calculations. So once we've added everything together, you're going to have your earnings to date. Now, this is everything that they've earned, and also the figure that you're going to use when you come to do your tax month 3 calculations. Little spoiler for what's coming up in the future. So once we're doing tax month 2 calculations, we need to make sure that our tax code adjustment reflects that. And as you can see in the calculation, we've got the tax code amount, which is adding our 9 once we've taken our L off. We then divide that by 12 to give us a monthly amount, because this is how we're paying Sally James. And then we're in month 2, so we need 2 months of that adjustment. So as you can see, 2096.50 is the adjustment. That's what we're going to take off of all of those earnings that they've had that year. This gives us a taxable pay of 7820.18, and we'll calculate the tax in a moment. So now what we have is the 3rd month in the year for Sally James. So we now go back to our 450 car allowance. We also have our salary. No bonus this month for Sally James. She's still riding on last month's pay. So our gross pay is back to 2616.67. We're going to do exactly the same things as we did in the previous calculations. So it says you try, not going to have people shout out simply because chaos it creates. So we're going to go through and just have a chat about these figures. So we are following exactly the same steps. Step 1, gather all of our gross from this month. What are they earning in this pay period? We know that, we've got that. We then make sure that anything that doesn't have tax applied to it, so in this case, our pension and give as you earn, is taken off because we don't want to apply the tax to that. It's going to ruin our calculation. So once we've got our gross and we've adjusted it for our items that aren't taxable, we then have our taxable earnings, which we add that 9,000 figure onto. So this is where we've got our figure from. It was from our last calculation. So once we've added these two together, this gives us everything that Sally James has earned in April, May and June. So she's earned £12,375 and twopence. Now, because we've moved on to the next calculation, we're now in June, our personal allowances are going to be different because we're in a new period. So we're going to get our tax code amount, 12579. We're going to divide it by 12 to get our monthly figure. And then we need 3 months worth of tax codes. So 314475 is how much we would apply. For Sally James, this means that her taxable pay in June would be 9230.27. What I would suggest when you're going through your practice and when you're creating your tasks, to make nice little grids like this to show you doing your steps, because you'll find once that's clicked and that's there, as I said before, it becomes a case of just going through those motions and you get the right figure at the end. So if you're doing calculations and you keep tripping up at the same point, either not taking off a salary sacrifice or net pay arrangement pension, or not taking the pence off when you get to taxable pay. These common errors within calculation can be easily resolved just by making sure you get that step-by-step process down. So we're now going to have a look at John Jones. So John Jones is monthly paid, and we're going to have a key difference when we're going to be calculating John Jones's tax. As you can see, John and Sally earn the same amount of money contractually, so their salary and their car allowance are the same. Now this is going to be, we're going to go through a little bit quicker on this one as it's a key difference that we can see. John has a tax code of K154. So as you can see in this part, we've got our gross pay, we've gathered all of our earnings, we've taken off all of the bits that we don't have tax for to give us the amount to be adjusted. That's our taxable earnings. We adjust it for our allowances to give us our taxable pay. Our key difference is that it's added on. So a K code is a negative tax-free allowance. Calculate it exactly the same as what you would do a regular tax code, but add it instead of take it off. As simple as that. They are rarer than L codes, but we do need to be aware of them because if we take the personal allowance off for a K code instead, we're going to come out vastly different to what we need it to be. So in this next month, we can see John in May, not quite as much of a superstar as Sally is, but still got a couple of grand. Good for him. So he's now in May, and he's got £4,616.67. That's his earnings. So he's got his contractual amounts, and then he's got his annual bonus that might be a performance based or otherwise. So we take exactly the same steps, and I know I sound boring, but we're going to get there. We gather the gross, make sure everything they're earning is included. We then get rid of everything that we can't apply tax to give us the amount to be adjusted for this month. We're then going to take in everything that we've been paid previously, in this case 2458.34, to give us everything that's been earned from the beginning of the tax year up until the pay period we're now calculating. Because we're in the May tax month, we can use the calendars at the beginning of this session to determine which tax month you're in if you're just given a date. and then you're going to apply the appropriate amount of personal allowance. So I almost said tax-free allowance, but obviously with the K code, it's not tax-free, is it? Because we're adding amounts on to be taxed. So what we've done is taken our 1549, divided it by 12 to give us 129.09. We then multiply that by 2, because we're in May, to give 258.18. We take that and add it on to our taxable earnings to give us 7174.86. Okay, so on to John's June. As you can see, the same as April, and we have the you try section where we're doing the same things. Gathered it, got rid of the bits, we've added everything in from before, and we've done our taxable adjustment to give us our taxable pay. This is what we need to look at. So we're now going to move on in a moment to doing the tax calculations for those months. As you can see here, we've got the rates for England, Northern Ireland and Wales. So our basic rate is 0 to 37,700. We then have from there to 150 at the higher rate, and the top rate being 150,000, over 150,000 in earnings. Now, I find when first introduced to these bandings, some people were surprised by the fact that people start paying 40% by the time they earn 37,000, but that you need to be aware that that also does not include your personal allowance. So someone with a standard allowance can earn just over £50,000 before they start paying 40%. So previously touched on it a little bit, but we've got Scotland who have more bandings than England, and therefore we need to be aware of how to calculate those amounts, and we will be going on to that module shortly. We will have a slight break beforehand though, and we're going to have a look at our taxable pays from our previous slides and go through and calculate the tax. So for Sally James's tax due, we look here, we have got 1410 and 9 pence was our taxable pay. The first thing we do when we come to do this is knock off those pence. Get rid of the pence, and it's only at this point you do it as well. So here, we knock them off, get rid of them. And when we look at how much we can use in month one in each of the bandings, it's quite clear that Sally James is quite a way underneath the 40% tax bracket with the amount that we need to charge. Therefore, it's a nice and easy calculation. £282 is due on that amount. A straightforward 20% calc. Now, when we get to May and we're including that large bonus, the impact that that has had on Sally James is that it's pushed her into the 40% tax bracket. And as we come down here, our first step, remember, knock off the pence, and we look down and see that they would have to earn £25,000 before they're paying 45% tax. We're nowhere near that, so 40% is where we're going to look. Now, once we've done the calculation to work out what we need in month two, so we've established for a pay period and then established for the period we're working on. So that's 6283.33 that we can have before we start paying 40% tax, and we're going to take that away from the total amount. So that means that we have 1536.67 at 40%. Now you may have seen a little bit of correlation there between what we've done here and what we did with the tables. So what we've done essentially is we know what this is going to be charging. So then we're just getting the remainder. So this is just an extra step, but it is handy to see it in the bands. And again, if you have a table that you create where you show how you're doing these calculations, you'll do it a couple of times and go, yeah, that's it. Absolutely. So in the 40% band here, we've charged 1536.67 at 40% to give us 614.67. And then we've worked out our pay frequency is monthly, so we've got the full banding divided by 12, times it by 2, because we're working in May. That gives us 6283.33 to charge at 20%, which gives us the 1256.67. Now, once we've added those together, we have got 1871 and 34 pence to pay, and that is on everything that they've earned in April and May, but they already paid some tax in April, didn't they? So once we've worked out how much tax they need to pay on everything, we take away all the tax that they've already paid this year to give how much we need to pay. So because they paid 282, we take that off of the total amount due to say in this period, Sally James needs to pay £1,589.34 in tax. Okay, so this is a U-try. We're going to go through it and we're going to see what we need to do. So once we get to month 3, Sally James no longer has those high earnings. And this is going to demonstrate a common thing that can happen if a company is set up in such a way that they have a lot of earnings going out the door early in the tax year. So as we can see, we've taken our pence off of that taxable pay to date. So that's 9230 that we are going to be looking at taxing. Now, all of our amounts, this one here hasn't been adjusted for a 3, but all of our amounts should be establishing what the rates are based on the period we're working on. So because we're in June, we're going to be getting the bandings. We divide them by our frequency and then times them by the month that we're working on. So once we've done that and established what the total amounts for the bands are, we then see where our earnings fit. So in this case, Sally James's earnings have now dropped below that threshold for the 40% tax bracket, and everything's charged at 20. So the 9230 is all charged at 20. But when we come to the stage of taking off all the tax that they previously paid, they've already paid more than what is due up until this point. So that's where you see this tax refund coming in, because Sally James doesn't regularly earn the amount of money that she's received so far this year. She received that £5,000 bonus. Okay, so for John Jones, I'm going to go through this one a little quicker because see, the impact of this one is slightly less on the basis that it's only a £2,000 increase that was received. So we've done all of the same steps that we did with Sally James. So we knock off our pence as our first step. Always important to knock off the pence when you come to I want to tax this. We're then going to make sure that all of the rates are set so we know what our maximum is. We're not over the 40 or the 45% rates. So we're going to charge everything at 20%, 517 due. So we take exactly the same steps as we did before. And as we can see, the same has happened. Now we've gone a little bit into the 40% tax bracket, and that's because we've had a bonus that's included to bring up that taxable pay early in the tax year. So we've taken the same steps as we did before. We knock off the pence as our first one, and then having a look at all of our bandings, we work out how much we can have in each banding. And we've breached the top of the 20%. We're now into the 40% bracket. And that means that we've got to charge the remainder, £890.67 at 40%. Now that means that we've got to charge the whole of that bracket, 628,333 at 20%, giving us the 125,667. Once we've added those together, that gives us everything that's due on all the earnings up till now, and we take off April's amount to give us what we need to pay this month. And we have another U-try, and this is for John Jones's tax month 3. And as you can see here, John, as a result of having a K code, so no personal allowance, and not going back into that 20% bracket as a result, you can see that there is a tax amount due, lower than the first month, but obviously more than the refund that Sally James got as a result of their tax code. So we have touched on cumulative and non-cumulative tax codes. We have W1 or M1 is a way that that's commonly displayed on pay slips and pay systems. It can also just be a 1, it can be an X, as long as it's clear that you're marking it as a non-cumulative tax code and producing the same one that HMRC has advised you of. So cumulative tax code will generally be just stated as the tax code. They don't generally have to say whether it is one, because with the absence of a month one indicator, it is one. And we need to therefore look at all earnings in that tax year when we're calculating. So this is an explanation of what I've been talking you through when it comes to the amount of tax paid. Now, because Sally James earned a lot of money early in the tax year, that would mean by the way that tax is calculated, she's going to be paying 40% in the period that it was paid, and then she gets that refund in the following month because it shows that she doesn't consistently earn that larger amount. Now, we also have a common query here in relation to tax code. So we're quite often contacted by employees in relation to tax code because that's our area of expertise and we're going to know more about it. So if you're asked to change a tax code from an employee, we must say no, because we can't change a tax code unless we're instructed by HMRC or a piece of HMRC approved documentation such as a P45. So what we would do in that case is we would refer them to the HMRC helpline. Oh, I'm going to test myself. 0300 or 0345 200 3300 or 3200 if you're calling as an employer. But you would call the HMRC helpline. You quote your PAYE reference and your NI number, and then they'll be able to help you and determine whether you need to have a tax code change. They'll then send through a P6/P9 to your payroll system, and it would get corrected. So there are tasks that are associated with this presentation. They can be completed on a Word document or a spreadsheet depending on your preference, but make sure that you have all of the information on there. So it needs to have your name, the module, the date you're submitting it, your tutor you normally have, as well as all of the tasks answered. The more clear you can put it, the better. So whatever works best for you when it comes to presentation. So when you're completing the documents and for this webinar, don't forget to complete your off-the-job log. Every entry needs to have what was done, what was learned, and what the impact of that learning is. So for instance, if you're using this webinar as an example, what was done is you attended a webinar to help you with calculating manual tax in England. The benefit of that you will get from it is you're now more clear on whatever aspect that you may have picked up from it. If you don't feel that it's given you any tangible answers, but you feel more confident, that counts too. So soft skills are something that you can note on your off-the-job log. So I would discuss with your own tutor your completion dates for these, when they would like them in, and this session will be attached to the session as material. So we've got those 6 documents, which are handbooks, resources and tasks for both English and Scottish tax. And then if you do run out or you want more practice, let me know and I can give you some extra tasks. So we have questions. We are going to reserve those for the Q&A. But what we will do is we'll take a short break to allow people to go and get a cup of tea, go go and get comfortable, and then we can move on to our Scottish tax.
And when are we coming back, Sam?
So if we have, what are we on now, 2:42, if we say we'll reconvene at 2:50, so 8 minutes, just enough time to go and grab a cup of tea, and then come back for the Scottish tax session.
Thank you.
Hello everyone. Feels like most people are back now. So what I'm going to do, I'll just turn my camera on shortly. There we are. So we're going to move on to Scottish tax shortly. We'll allow people to come back, but whilst we're doing that, what I'm going to do is just pop up a little poll. Same thing as what we did for the English tax. I'm going to launch this, and it's how confident are you when you're approaching a Scottish tax calculation? So a couple of minutes just to see what the feeling is on the call as to Scottish tax. Okay, so it looks to me as if we have a lower turnout in this time for people that are feeling more comfortable. So this is an area where people are having less confidence in calculation. That's probably due to having a few more different bandings that they have to consider when they're doing the calculation. But if I'm honest, when you're coming to use the method, you're going to use the same method, and you're also going to have a look at the table method for this. It's exactly the same. Are we in the right one? If it's yes, grand. If it's not, just calculate our figure and add the two together. So it's a nice way of looking at these. So 1 second, whilst I just switch over to new presentation. So apologies. Okay. So I seem to have lost my button here for screen sharing. Can I ask what can be seen on screen at this point?
We can see the quick poll, the Scottish tax one.
Fabulous. Okie dokie. So we've had the vast majority of votes have come in now. So I'll just close that poll. There we are. And
now we can see you, but we can't see any slides.
Well, I mean, you'll get those in a moment.
Exactly. We'd rather see you in the slides on. There we go.
Fab. So can you all now see my MBKB?
Yes.
Fabulous. Right, so we're now going to have a look at Scottish tax. So, like I say, vastly similar to English tax in the way that we're going to calculate it, but I find that it is daunting to people because they see that there's, two more bands that we need to look at. They have different tax codes, but ultimately, it's very similar. So I'll just turn my camera off and we'll get started. We're going to have a look at the manual calculation of Scottish tax now and have a look at some of those different methods that we used before. So this is vastly the same as our English tax, but it says here, please note this does not cover employees based in England, Northern Ireland and Wales. So this is specific to residents of Scotland, and as previously stated, it's determined by your postcode. So if you live in Scotland, you've got a Scottish postcode, you will eventually get a Scottish tax code. So we have the same detail here around the introduction of PAYE as a system, with the addition here of the 5 tax bands coming into play in 2017-18. So payrollers that have been around since before then will know the time that they've not had Scottish tax, and it used to be consistent everywhere. But newer payrollers won't know any different. It'll just be the system. So all of the same information in this area where it comes to understanding the difference. However, we do have the addition here of understanding how it differs in Scotland from the rest of the UK. So we've gone through the difference already with our Scottish tax codes and the fact that we need to be aware of the SDO, SD1 and SD2 codes. They are rare in usage, but if we don't know what they are, they can become a shock if you get one. And then convert into monetary values. We're going to use exactly the same method as we did before. But one item of note that I would put on here is that SK indicates a Scottish K code. So we're going to remove the SK and add our 9 to the end. Remember, don't add it to the front because it will be vastly different to what it needs to be. So there are bands again, and we have the links to our manual method. So the overview of the use of the pay tables. So pay table A applies to all UK taxpayers. Doesn't matter if you're in Scotland, Wales, Northern Ireland or England, you can use tables A, and that's because they're universal. It applies to the number in the middle, not the prefix or suffix. However, once we get to tables B to D, there are designated sections. So pages 12 to 22 is the section that we have for our Scottish taxpayers, and this is what our pay tables look like. We've got the example there. It's exactly the same as the one that we see in the English pay table, apart from we have the addition of the S as the prefix, and you use exactly the same method for calculating that tax code adjustment. Now, this is the part that people tend to find daunting. When we look at this table, it's a bit more complex than we see with an English one, and therefore people can find it a little intimidating, but it's not. It's nice and easy. So the Scottish Parliament, based in Holyrood in Edinburgh, set their own rates and bands for Scottish tax. And what you can see has been done here is Scottish rates have been slightly lowered for people on lower earnings and slightly raised for people on higher earnings, so that they have a differentiation between the rates in Scotland and the rest of the UK. So here is a nice handy reference table to show you where you need to be looking for each of the tables within tables B to D. So you can see here, table B is on page 14, and you've got C1234 for monthly and C1234 for weekly, all between pages 15 to 18. So the key questions that you need to ask yourself when you come to use tables B to D is: 1, what jurisdiction does this person sit in? Is it England? Is it Scotland? If it's England, then you're going to be using the start of the pages. If it's Scotland, you're going to be moving straight to pages 12 to 22. So if you're paying employees monthly, use the table on page 12 to begin calculating how much to deduct. So as you can see here, we've got, similarly to the other ones, we have month numbers and then we have column numbers. So that 174 is 1 month's worth of that first starter rate. So our example 1, we have a taxable pay of 605.98 at tax month 4. So we go to tax month 4, and the employees earn less than 695, they'd only pay the starter rate. So what we would do is then turn to page 14, table B, and then we'd work out the starter rate. Now, when we come to do other calculations with a bit more earnings, we're going to then move on to the C tables. So once we've calculated whether someone sits in the right tax bracket, this person, they didn't have enough to be in the C tables, so we're now going to be looking at B table to see how much tax to charge. So what this shows is total taxable pay to date. If they have £1, we charge 19 pence because it's 19%. And you're going to use this table to add up all the necessary amounts until you get to the amount that you want to tax. So taxable pay is 605.98. We would look up taxable pay of 605, and the tax due is this amount. If you prefer not to use table B, simply multiply the amount of taxable pay that you have by 19%. Remember to ignore your pence. Oh, I like those little reminders because it don't frustrate me when I see pence on a taxable pay. Right, so example 2, the employee has a taxable pay to date of 1154, so they are earning a little bit more, and that means that we're going to move on to table C1. So in exactly the same way as we did for English tax, the first thing we do when we get to the C tables is ask ourselves, what month are we working in? Well, we know that we're working in month 4 for this example, so we go in month down to 4. So then the check that we need to make is that amount in between the two figures that we need to look at? And if the answer is yes, fabulous. The answer is not, then we need to move on. But in this case, we are sitting in between it. Now, exactly the same again as the English system, we're going to take that column 1, and that tells us how much sits in all of the bands before it. And then column 3 tells us how much tax is due on that amount. So that only leaves us with the remainder of what we've got to calculate. So as we see here, we have got 459 that we need to charge at 20%, because remember, when we're doing our remainder, you can literally look on the right hand side and it will tell you what the remainder has to be charged at. Or alternatively, you can go and have a look at table D1, which would tell you how much you need to charge, similarly to a tax code adjustment. So now we have example 3. So an employee in tax month 4, so we're working on the same one, has earned taxable income to date of 5,280. So we look at C1 on 15, and this exceeds the amount in column 4. So we have gone here, we've looked, does our 5,280 sit between these two figures? No. So we have to move on. So we then move on to the next table. Are we in the right table? So we go down to our month 4. We had 5,280 that we were looking at. Hooray, we found the right one. So we're now working in the right table. Fine. So we take away column 4 from the total amount that we had, which gives us an excess of 1060, which we need to charge at 21%, because as it says over here, what one you're going to charge your remainder at. If you don't want to do it that way and you want to use tables D, then you can go to D2 for the 21% rates. We then get the amount that we have at 21%, and we would add that to the 837.05 that is chargeable on the first 4,220. Okay, so our next example, we've got someone that is in tax month 9 and has a taxable income to date of 24,157. So we look at looking at table C2, pay exceeds 4 and 5. Okay, so we're going to get 24,157. We're on tax month 9. So do we sit in here? No. Do we sit here? No. We've got too much, so we need to move on from table C2. So in this case, we're going to go to table C3. So we're in tax month 9, and we're going to have a look. We now do sit in between these two figures. So we're using the right table. Now we now know from this that 23,198 attracts £4,761.10 in tax. So once we take that amount away from what we had to charge, 959, you have down here, that's what we're going to charge as a remainder at 41%. So we look to the right and it says 41. But if we don't want to do that, we go to tables D and work it out that way. We add them together to give us our total amount of tax payable. So only ever two calculations. We've got one that we take from the book, one that we calculate, add them together. So our next one, we now have got some rich people on here. So we've got tax month 9. We've got an earnings of 113,459. So we're going to look and see, okay, so we've looked on table C1, too much. C2, too much. We now look at C3, again, too much. So we need to move on to C4, which is the last one for Scotland. So very rarely would you use this, but we do need to be aware of how to do it. So what we're going to do, because this hasn't got another band to go to, it's just got an amount to charge tax on. So on the first 112,500, we're going to charge £41,374.92p. So that's a lovely amount of saving on admin for us, isn't it, to work out all of that for all those different amounts. So what we do is just take off the amount that we've charged tax on already, this 112,500, from our 113,459.98. We ignore our pence to give us 959, and then we'd add those together to give us our total amount payable. So £41,816 and 6 payable. So very similarly to English tax, all you're doing for the table method is checking, do I fit in between these two figures? If it's yes, great. If it's no, move on. If the first figure is too much, you've gone too far. So it's one of those, you need to keep looking and make sure that you fit in those two columns. Once you do, you already know how much tax you're charging on the first figure, and then you're just working out the remainder. And what you need to be aware of when it comes to cumulative and non-cumulative tax is doing those steps that we saw with Sally James earlier. So what we need to be doing is adding in all of the earnings that they've had up until that point in the year, if they're on cumulative. And then once we've worked out the tax on everything in that year, we need to take off all the tax they paid so that we can see what's needed to be paid in this period. So breakdown of tax liability. So an employee has a taxable pay of 85,000 in month 10 and is on tax code 1250. Give a breakdown of their tax liability at various rates. So what we've done here, you can see, is their pay adjustment. You've got your 9 and you've popped it on the end, and you've taken your suffix and your prefix away. You've determined, as per your pay frequency, what you need to be dividing by, and then times it by the month or week that you are working on. That gives 10,424 in this case. Therefore, taxable pay is 74,575.80. So the earnings on of 1738, column C1 here, the tax of 33022. and then 1738 times 19% equals 33022. So the earnings we have of 10549 equals tax of 209243, and then once we've added those, we've got 8811 tax will pay at 20, and these are the amount of tax payable at 20%. So it's continued on the next slide. As you can see here, we're doing it by each one of the different tax bands. So the first amount we had was 1738, which is taxable pay at 19%. We've then got 8,811 taxable pay at 20. So the earnings of 25775, column 7, equals 5289.89. And what this means is that on table 3 calculates pay and tax at 19, 20 and 21. So then for this one, you can see that by adding each of the different amounts up, you would get to 25297.89. So it is a good way of doing it. Like I say, if you break it down so that you're doing each step of the calculation individually, once you get the process, it's a case of applying that process to each set of figures. And especially with the table method, I find that it is a nice linear way of going through things to make a nice foundation of knowledge. So for this one, again, you've got tasks attached to the session that you can access, organised with your regular tutor as to when those need to be in. Each employee will be given a tax code, salary and pay frequency. Obviously, they'll be Scottish for this one, and you'll be asked to calculate their annual income tax and income tax for their pay frequency. So you'll need to add in the calculations you have used and your workings to evidence your understanding, because just giving us an answer doesn't show that you understand it. It means that you've managed to get the answer. So the more detail you can provide with the steps that you've taken, how you've broken it down, what you do, and also in your reflection at the end of that task, how did you find it? Did you find it easy? Did you find it a struggle? Is there a way that we can help you with further understanding income tax and how that's calculated? So it does say to complete the task on a Word document. Like I say, for my learners, I would accept a spreadsheet as well, as long as it's got all of the information that you would need on it. Make sure that all the tasks are covered and that criteria can be marked off. So upload it into Smart as you normally would. Your tutor will have a look at it and make sure that the answers are how they should be. But if there's anything that you just don't know, reach out before you finish just to say, what do I need to do in this area? Again, with the 20% off the job, make sure you're putting in what you did, what you learned, what the impact of that was, and make sure that you identify the amount of time that you did to do it. Just as also as a note, don't be skimpy with your time. I find a lot of people, when they're reading a document, will only provide the time that they physically spent reading the document. I don't know about everyone on this call, but I find I spend more time digesting a document than I do reading it. So if you're doing study time, make sure you include all the time that you were reviewing, researching, contemplating, and put that in your entry to show that you are, you're taking your time to do your research and digest this information. Now, questions for today. We are going to have a look at some of the questions that we've had throughout the presentation. So I will first just share a short poll, as I've been doing, just to say, what topic do you feel is of most concern in payroll right now? And then once we've got a few different answers, if there's any other that have been put in there, we'll pass back to Helen to go over any that have been raised throughout the presentations. Okay, so we've got quite an even split, it would appear, as they're coming in. Oh, we do have a lead coming in for the CJRS and furlough. So I suppose that would very much depend on what industry you're working in, what areas you're working in, as to how that impacts your company, because some people haven't used the CJRS for a long time, other people are using it up until the end, and as we approach the end, it tapers in terms of how much support is given by the government. So it's consistent change, isn't it? So it's very interesting to see the different perspectives that people have, even when we're all in the same industry. So I'm just going to close that poll now, and found that pensions, IR35 and CJRS, and the main focus is GDPR. That one, I agree, that one's probably passed as a hot topic, but it's always there in the background and it dictates a lot of what we have to do. Didn't have any others, so what I'd like to do is just pass it over to Helen to see if there was any interesting questions that came up throughout the presentation.
Okay, thanks, Sam. First of all, can I just come in on the back of your poll? Just to, I mean, the CJRS and furlough is something that I can definitely do. I can do some sort of webinar to help if we know that people would benefit from it. Even though it is coming to an end, I can do something for that. But just to let the people know who are struggling with IR35, if you look on the MBKB website under information and then payroll resources, there is a webinar on there about IR35 and off payroll working. It lasts nearly an hour, I think. So you might find it useful to go and have a listen to that if you can cope up with my dulcet tones. And then if you've still got any questions after that, then we can pick them up. But that is something that we are aware that people struggle with, so we have done a webinar already for that. So if we look now to questions that have been raised throughout, we've got an issue, Sam, with when to drop off the pence when you're calculating the tax. So do you drop off the pence at the time that if you're doing 37,700 divided by 12 and times by however many months, do you drop off the pence at that stage, or do you drop off the pence before then or after then? And that's one that's come up a couple of times.
Okay, so I would drop off the pence when you know what you need to tax. So at the point that you've adjusted, you've gathered everything, you've adjusted everything, you've adjusted your tax code, and you know what you need to tax, you're going to drop those pence. So what we did in those calculations there was ignore the pence once we've got through to that end, the end calculation for the end banding. But what I tend to do is, drop the pence at the point that we know what we are taxing.
So the question goes on. We've got two questions from the same person, but about on the same kind of topic. So if they've gone into a specific now, if the taxable pay for someone was £3,485, some of that is going to be at 40%. So would they use 3141.67, which is the amount that they've worked out is taxable at 20%, or would they use 3141 and drop the pence off? So do you drop the pence off at the taxable pay, or when you're starting to work out how much is taxable at 40% and 20%?
Within the tax bands, you would keep the pence in. Am I right?
Yeah, yeah.
For a moment there.
I know, it makes you question yourself, doesn't it, when you look at it?
Yeah.
So I think the slides that show where you've worked out the taxable pay. So when everybody gets these slides later on, or looks at the slides later on, or if you've already got PRT1, if you look at the slides then, it shows you when you come to start working out the tax that the taxable pay for the year is so much, £7,485.29, and at that point you drop off the pence, so it'd be 7,485, and then you start to work out how much is at 40%, how much is at 20%, and that kind of thing. Do you agree?
Yeah, I always like to think of it as a separation between tables A and tables B to D. So before you get to using tables B to D, you shouldn't have any pence on the end of it.
Right. So that's marvellous, because the person who asked the question has come on now and said, that answers my question, thanks, which is great. We like to know that we've done that, so that's good.
Fabulous.
So if we move on to the next question, the next question is about, let me just get to it. We'll come back to the one about tasks. So somebody wants to know whether the tax code affects the amount that is taxed at a particular tax bracket. So the question is, 37,700 will be the bracket for 40%, even if the employee's tax code isn't 1257L.
Absolutely, yeah. So we're gonna they stay consistent. Our brackets are always going to be the same. The adjustments that we're making for tax code are going to be made before we get to that point. So although, like I say, it looks like the maximum that you can earn on a 20% wage would be 37,700. Once you add in the tax-free allowance, that does push someone's earnings to almost 50,000 that they could get before they start paying 40. But it does depend on their individual circumstances.
It absolutely does, because some people get tax relief for certain things that can push it above the 50,270, depending on whether they're getting relief for something.
That's true. Work, if you have to, wash your own work uniforms, you can get relief.
Yes.
Working from home, you can get relief as well.
Absolutely, you do. Yes. So, does that answer that question for you? Wait for her to reply. In the meantime, we have somebody who has asked about interchangeable terms. So what she's interested in is, are taxable earnings the same as taxable pay? And I think that this is something that is really important to highlight, because we do know that people, when they've been going through the role simulations or even the multiple choice questions, sometimes get confused if something's referred to in a terminology that they're not familiar with. So taxable earnings, yes, are taxable pay, but then you've got things like tax-free allowance, or tax-free pay, or tax adjustment, and that's all the same thing as when you're working out the personal allowance, the amount that somebody is allowed to earn before they're taxed. And I think that it would be good to make sure that you familiarise yourselves with the different names for things across the board. Maybe talk to your tutor and see if there are any terminologies that you're not certain of. What do you think, Sam?
Yeah, so taxable earnings is all of your bits and pieces in before we've made those adjustments, and taxable pay being what we're then going to be taking to tax. So yeah, it is good to think of those, and just a handy tip for those two in particular, obviously they both start with taxable, but the times that you would be thinking of them, earnings is before, so it's what you're earning, and taxable pay would be looked at after. It's what closer to what you were paid. So to know which order they come in. But yeah, it is an interesting one, and also knowing what needs to be applied to each item. So when we come to do later ones, you have things like your taxable, NIable, and pensionable pays that we all need to make sure we're applying the right rates to.
Yeah, I mean, just carrying on from that, remember tax is payable on all your income, and national insurance is payable on earnings. So you're not always taxed and national insurance on the same thing. So earnings and income, it's very important to understand the difference between them as well.
Absolutely.
So we have a question that talks about the tasks, and someone wants to know, as soon as we referred to the tasks, are these the same as are in PRT1 if someone has already done the PRT1 module? Yes, the tasks are the same, but if there are things that you are still uncertain of, I would suggest that you talk to your tutor about the areas that particularly you feel that you want some more practice on, and ask them if they can set you any additional tasks. Sam, you're a tutor. What do you do with your apprentices?
So it tends to be we go through the normal tasks. If you have done your PRT1 tasks already, then you will need some additional ones if you've gone through. Absolutely highlight if there's any issues, because that allows us as tutors to go through and create anything that might be tailored to you personally to help you through. But we also have different resources, tricks and tips that we can go through with you to help that click. So I've got some different ones, or K-code exercises. I've got some additional tax exercises that I put together for learners. So if you highlight to your tutor, I would like to practice such and such more, odds are they'll either have something or be willing to help you with creating a new resource.
So someone's put, I noticed on the PRT1 task, the tax codes are different to the one shown in this webinar. You're on the ball, my dear, you are. And that's because this webinar has been updated for this current tax year, the 21-22 tax year. The PRT1 tasks, I would assume that the version that you've got is the version that had not yet been updated, but it's all been updated in the last few weeks.
Wow.
So I think that that's all the questions that we have, unless anybody else has any more.
Okay, so before we do go, there are a couple more, as you can tell, quite like the polls. So just to get some feedback on today's session, your tutor will be adding to SMART this session. I'll be sending a list out to all tutors with the attendee list. And then once they've got that, they'll be setting up your sessions on SMART so that you can get the feedback and whatnot in there. But I'd just like to ask how likely you would be to attend a session in this format in the future, because this is a relatively new format that we've tried today. So I'd just like to get your opinion, if that's okay. Oh, fab. So some really nice responses in there. So it seems like it's been quite a popular format then. We are exploring different ideas when it comes to subjects to cover and tailoring it to certain individuals and whatnot. So let me know what you feel. Reply in the feedback, put it on your emojis, whatever you feel that you would like to do. I'll just close this one shortly, and what I'll be doing as the last poll is just asking what emoji you would be giving today, and what that will do is allow for evidence to be provided on the session within SMART.
Sam, you've got one more question in the chat box.
Oh, yes.
I'm not sure if that's one that you want to pick up here or whether it's offline. I don't know whether it's quite relevant for the today's questions or whether you'd rather take that one offline.
Let's have a look. What questions have we got?
It's how should we process a leaver who left 3 months ago and was not processed?
In a panic.
Yeah. Can we take that one offline?
Yeah, so I will reply after with that one, just to give a rundown of some of the checks that you would need to make in order to have that, to have that correct, because it would depend vastly on what's happened in between and what's caused it. So yeah, happy to chat about it. I've got your email address because I have had a chat with you before, so I will pop an email as a follow-up just to answer that one. But thank you very much for everyone who's supplied that vote on that poll. So that will conclude today's session on income tax and our little Q&A. I'll be sending information out to all of the attendees after the session today so that you've got everything you need. If you need anything additional, reach out to your tutor or me or whoever you need to, and we will definitely help. Thank you very much for attending, and I look forward to seeing you on the next one.
Thank you. You might want to stop recording.